back to the big story, and that is how the financial markets are reacting to this major GDP howler. Yes, the numbers are bad, but it's also getting the market really excited that the RBI will quickly start offering rate cuts, which is also up for debate. Because remember, the last CPI print was well above RBI's comfort zone. The CPI printed above 6%. So will the RBI bite in December itself, on Friday itself? That's the big talking point. And what does it mean for financial stocks, the listed stocks? That's what we're focusing on. Sameer Bhise, banking research analyst at JM Financial Institution, is joining in. Sameer, your first thoughts on, what you would expect in terms of, treasury gains, if any, if that could be something important to look at. And this, I'm only talking about the near term and also obviously the NIM trajectory. Whether you think the RBI will start cutting faster than expected post this GDP print, and whether that will, alter your view or influence your view in any way.
Hi, good morning. So I think in our base case, clearly a December rate cut is a relatively lower probability event. However, what the GDP print does is probably moves it closer than what one would have expected. My primary view, or how we are thinking, is probably liquidity management, which has been tight for a prolonged period of time. You could see some steps coming on easing liquidity. I think that could be the first steps from the regulatory perspective to ease in the environment and probably give a push to growth. However, RBI has multiple times said that probably the inflation battle is not won yet, and hence they would still continue to focus on that, which is what the primary responsibility of the monetary policy is. So in my assessment, I think a near-term rate cut looks more difficult. Probably we could see some bit of easing on liquidity, is how we are thinking about it.
Okay, so I guess that, the weekend developments don't really change your stance per se on stocks and sectors. So just moving on to the other major news development, which is this whole co-branded credit cards business and RBL-Bank and Bajaj Finance. Do you have coverage on either of the stocks or both of the stocks? Any thoughts?
So we don't cover RBL-Bank, so would want to kind of refrain comments. Just that it has been on expected lines. Prima facie, because reliance of RBL-Bank on Bajaj sourcing had been reducing over a period of time.
Sameer, hi, morning, Prashant here. Just to go back to that first point on growth and etc. And markets, of course, always latch on to help either from the fiscal or the monetary side, and the monetary is, of course, also around the corner with the RBI policy. It's not so much about what will happen in this policy on Friday. But one of the reasons why personal consumption has also taken a bit of a hit is because the regulator has tightened the screws across the board, right? NBFCs, MFIs, banks, etc. In terms of, asking companies, and rightly so, to toe the line in letter and spirit. And this year we've seen so many actions in that sense. At a broad, slightly higher level, do you think, Sameer, we should expect maybe some loosening there because liquidity is hurting. I mean, banking credit in that sense has been tight.
Yeah, so I think fair expectation to have. I think the regulator remains concerned on the leverage building up on the entire consumer credit side, which is what had caused them to start tightening last year. I think a large part of that has actually resulted in this kind of a slowdown in terms of consumption, and fairly so from a regulator's perspective. They are willing to get the system right, even if that means foregoing some near-term growth. And the way unsecured consumer credit had been growing last few years, I think it was only warranted. I think at some point in time in first half of next year is when we would see the large part of this impact has flowed through the sector in terms of weeding out the painful points. From a regulatory stance, I still think rather than just signaling a rate cut, I think there are other ways where they could see easing of some of the requirements. Maybe it could be CRRs, or there could also be some ways of easing LCRs, which is what the primary guidelines had suggested, that they could be further tightened. Maybe you could see some bit of tweaking around that, given the way growth is panning out.
Sameer, for investors who are watching, from a financials perspective and stocks under your coverage, are there any straightforward, absolute return ideas here, or it's all a little
So I think we have
cloudy?
preferred
Yeah.
larger banks over the smaller ones. I think that has been the stance over the last 1 year. Have been highlighting. So I think that still continues. However, would like to highlight that if a rate cut plays out in the extreme short term, it probably is a minor negative for the sector, given that large part of the asset side is linked to repo rate, and that would reprice lower immediately, while deposit repricing would follow later. In such a context, I think the toss-up is between who is impacted less. We still think that larger banks are better placed to kind of navigate. They also do not have meaningfully high exposure to the unsecured bit. So asset quality risks are also lower. Our topics are ICICI, Axis, and SBI. I think that continues to be the case.
ICICI, Axis and SBI. Got it, Sameer. Thank you very much for joining in.